if you close your eyes.
Emotional damage. Woo! Baby, I know you're the one going through emotional damage right now because you are the clown that got convinced to take margin out into a vertical line stock thinking that that was an infinite game until finally the chickens have come to roost, baby. The markets are correcting, crashing, opening up some opportunities, but I'm going to explain to you why they're continuing to drop in the stocks that still continue to interest me the most, where I want to buy in data that not a lot of YouTubers are talking about that I think is relevant to the information you need today. So if you're on a path to financial independence, if you damn well one day want to retire early, join me on that journey, folks. Hit that subscribe button because nobody does it like we do it here on YouTube. A influencer clown that is fighting the hedgies out there. Firstly, let's talk about the actual margin debt. A lot of clowns out there like to use in vertical line markets when pump and dumps are the almighty trend. You know, Trump pumping up his meme coins. I mean, this is when people get real frothy and you see it. Like, it's so funny that in the dumbest market environments is when people get so stupid to double up in leverage, right? Because that's what happened in 2022. And all of that are hundreds of billions of it unwound. And this is only updated basically as of what? We got updates here as of coming into January, the end of January. So something tells me that this isn't vertical lining anymore. There's likely that this is starting to unwind. And what's crazy is that people got comfortable using margin in a higher interest rate environment. So something tells me what we're seeing is margin calls, leverage, options, all that stuff starting to unwind a bit, right? And a lot of money continues to flow into money market funds. And where my speculation and my curiosity truly lies, as this amount hits 7.2 trillion, up over 2 trillion since the pandemic time or since 2021. I mean, there's so much money sitting on the sidelines. And I've been speculating this is coming in from foreign markets because in Canada, Japan, China, all over the place, we've seen interest rates drop materially along with their currency values, leading people to throw their money into US dollars, US savings, US money market funds because they're getting that double-edged return of not only currency conversion value, but obviously getting a 4 to 5% return just on that cash. And something tells me now with the markets pulling back on the fear of tariffs and recession, some of that money is finding its way into here as these values continue to balloon. So what happens when we actually cut interest rates? I'm so curious if a lot of it starts flooding out of USD back to foreign markets, if it finds its way back into equities and the stock market. They're just fun questions to be asked because seeing charts like this in both spectrums is just super, super interesting to me. But if you want to take advantage of that, I mean, if you're scared of this market, if you can't handle this kind of volatility, it's good to put some of your money into long-term treasuries or looking at short-term places to park your capital, like in HISU. This is a Canadian high interest savings ETF, which is what surprises me is there's not a lot of US investments out there that offer something similar from an ETF standpoint. There's also UCSH, which offers a 4% yield, and this one offers right now about a 4.23% yield. And all these funds do is put your money into savings accounts essentially, and they basically give you payouts literally. I mean, this is just holding what? A Bank of Nova Scotia deposit US, NBF deposit account USD. So these are just US accounts collecting US interest, right? If you take a look at the performance overall, or can we see the chart? Where's the chart on this guy? Yeah, you see that basically just it's a flat fee that you pay. It's like $50, and then every time they collect interest, every month they pay that interest out to you. So it's a very interesting way to park short-term cash until they start the interest rate cut cycle if it's something that interests you. But obviously at the back of a 4.5% yield, I mean, we're still sitting in a market environment where there is concern about when this yield's going to come down. But if you're not looking for long-term and it's just short-term parker places, you can't look for a better place. Well, like I tell you, if you need cash in the next 1 to 2 years, 6 to 12 months, 6 to 24 months, put it in one of these ETFs. It's a great short-term parker place that comes with a lot more security in the market environment. But let's talk about the S&P 500 because, yeah, though the markets are crashing, it seems to be more of the speculative pull-forward valuation-like stocks and the Mag 7, which really kind of fall in line with that statement. But, I mean, what we're seeing is about a 10% correction. We've been hovering around this 10% area. I do not know if we go lower, but obviously I've been buying. I mean, the wife and I have been loading up down here. I got some more capital. I'm getting, obviously my bi-weekly paycheck from my job, obviously, like I've got dividends coming in and so much to keep piling in here because I'm not a sideline guy. Like, I'm cost averaging and obviously being more aggressive in these kind of periods because they do get me ever more excited. Because right now on VOO, the PE ratio that has not been updated as of mid-March, I think it was last updated February, there is sitting around a 26.9. I mean, the growth rate, the earnings growth was nuts here at 19.4, but it's likely that's going to slow down. And I want to show you the data behind this in a moment, because we do have some very fascinating data since earnings have come out from the last period. But I mean, if we take a look, again, it's the Mag 7, right? It's any kind of pull forward valuation like stocks where the market becomes uncertain, because these are the companies that have the highest capital expenditures going on with AI. These are the companies like we'll talk about with Google and Meta, but these are the companies that usually see the heaviest hit when recession fears come around, which is why there's so much money flooding into the rest of the market. It's why your dividend ETFs like SCHD, VYM, DGRO, these ones have actually maintained being green on the year and aren't actually negative. And it's why I like having them as part of a balanced portfolio of income and growth. So that way, obviously, when markets slow down like this, I'm still collecting relatively fat paychecks, because obviously Google, obviously the Qs don't pay anything out, but I like to have reinvestable cash when things get a little tight for people and fear tends to sink in. Now, I want to show you the actual earnings growth. Basically, the pull forward PE on the S&P versus the growth that it has, because this chart I think is a very good accurate indicator of when the market might be overvalued or undervalued. And obviously, as everyone's predicted, that we are in an overvalued market that could still potentially have some pullback opportunities here, because when you're looking at this line, there's a forward 12-month earnings per share versus the price of the actual S&P, and we can see that we're trending above that pull forward 12-month earnings per share. So we are obviously trading in a bit of an overvalued market still, but read the metrics here, because again, this was announced as of March 14th. This is a very fascinating data, because for Q1 of 2025, the estimate year-over-year earnings growth rate for the S&P 500 is 7.1%. If 7.1% is the actual growth rate for the quarter, it will mark the 7th straight quarter of year-over-year earnings growth reported by the index. But we have been seeing earnings revisions. Basically, the earnings growth rate for the S&P 500 for Q1 2024 was 11.6%. All 11 sectors are expected to report lower earnings today compared to the December 31st due to the downward revisions to the earnings estimates. With the guidance, and this is where everything kind of comes into play, for Q1 of 2025, 65 S&P 5 companies have issued negative EPS guidance, and 39 S&P 500 companies have issued positive EPS guidance, with the valuation for the 12-month PE ratio sitting at 19.9, which this PE ratio is above the 5-year average of 19.8 and above the 10-year average of 18.3. So when you're looking at markets, especially with the tariff war, with recession fears, we have no certainty. We have no guidance right now because we're in the midst of an earnings quarter. A lot of this started in January when Trump's inauguration came around, and now we have to wait till earnings come out to see if this impact really justifies the correction we're seeing in some of my favorite stocks. And the reason that I think we're seeing Google and Meta get hit pretty hard here, because a lot of people are asking me, like, these are great companies, they trade at great values, they have great growth rates, why are they dropping? And that's because in fear of recession, the first thing people stop really throwing money at is marketing spend. And these companies, obviously, just like through the 2022 crash, marketing spend starts to freeze up a bit and people get like hyper concerned. But with the market penetration these companies have, with basically half the world using Meta, like I'm sure almost the majority of the world is using one of Meta or Google's products, these are like basically cyclical trends that I think open up buying opportunities that I want to actualize on. Now, we picked up some Google. I might even buy some more if it keeps dropping here. I'm not in a rush. I do, again, have some cash that I still want to invest, but I'm just taking it a bit slower here because I just want to see if this correction continues, as I already offloaded a lot of capital into these markets. But when you look at companies like Google and Meta that have self-driving, genomics, quantum computing, Meta and VR, and all these future prospects with AI, yet these stocks trade at wicked discounts, like none of that future prospect even exists, it still makes me question and wonder how companies like Tesla, Palantir, these companies, like Palantir has good growth, don't get me wrong, but they trade at nosebleed values, even at the current valuations we sit at today. Like Tesla has zero growth. Their future prospects have no foundation currently in the market. They're all just that, future prospects, whereas Google self-driving is implemented in the market today. These companies deserve to correct so much harder. And I don't know how people are so comfortable holding them here, especially when we see what's going on in China. Like, China is one of these places that I find really interesting because they're usually not the first mover advantage markets, but they do tend to excel at manufacturing. When they figure out what's going on and what the trend is and where the future is going, they pick up on it so damn quick. I mean, we've seen that obviously with BYD, that is now trading at a higher market value than Tesla, I believe, and is actually crushing the market with valuations on their cars and making mass market vehicles. Tesla's a premium market vehicle right now, in my opinion. But look at this robot. I'm going to turn the audio down. I hope it doesn't get me in shit because obviously it might be copyright. I'll have to fix it after the fact, but this is awesome. I mean, how cool is this? Look at this thing. This is how Tesla's demo should have went. Tesla, like Apple usually does, shouldn't have said shit about their robots. They should have just waited, let Figure AI do what they're doing, and then they should have just came out with a video like this to introduce the robot. It would have done so much better for the stock than promising shit that just never existed. Now, I'm not saying China, like, this is a really cool robot that a lot of people are getting hyped about right now because it's running, it's doing front flips and all this stuff that we haven't really seen out of, like, the Tesla bot. I mean, we've seen it with Boston Dynamics and stuff, or, you know, Figure AI, but they seem to be more focused on real world application, finger movement, and I think that's going to have a higher value in the market. But you got to admit, like, this is still super, super cool stuff, which is an endless reminder on why you should be more than likely cost averaging into things like XEQT, because getting global market exposure through VT or market ETF like this really solidifies the idea that, you know, Western stocks aren't always going to be leaders. Again, like, look at Tesla here at a $711 billion valuation. Yet if you look at like BYD at a $776 billion valuation. And again, you got to ask yourself, like, where's the future of these companies going? Because if you look at the prospects today, and we're just looking at auto, BYD looks very promising right now and comparable, especially when you talk about valuation metrics. I mean, again, you could talk about BAB up 69% this year, JD.com. Again, I'm not saying China is like, China's got a lot of work to do. They're not a perfect economy, but neither is the US, right? So I always find the shunning and the propaganda we get out of the Western media is hilarious. I was just looking at a TikTok that was funny, because you ever look at world maps around the world, like how Australia map looks compared to China's globe map versus the Western world's globe map? Like, it almost feels like propaganda to think that you are the center of the world, you are the center of capitalism and everything that matters, and it's hilarious because it's just never the case. So I feel like the propaganda has led investors probably down the wrong path to some extent, but you want global diversification, right? So this is why, again, we're starting to buy XEQT for wealth preservation. Now, if you're younger, I don't know if this is perfectly prevalent. You'll have to figure out what works best for you, because I think, again, with the opportunities that are opening up in Google Meta, you know, these are great stocks as well. Not as financial advice, but things that I like to personally buy as a young investor that still wants accelerated growth in their portfolio. But I will pass that question off to you as always. I'd love to know what you think about this market environment, what you're buying, how you're stomaching the volatility for the first time. I feel like I've lived through this 3 or 4 times now, but for some reason, you know, with the degenerates out there that seem to just stumble into this market when everyone's making money later in the game, have to realize you got to have a long time horizon. But I'd love to know how your emotional damage is dealing with it. So stay cool, stay awesome, and as always, I look forward to catching you in the next one.